In today's video, I am going to be breaking down what I call my TSX master list. This is 11 of the strongest, most solid companies on the TSX. So let's get down, let's check them out. And by the way, they all pay a dividend if you want to have a fantastic growth and of course income supplement. First is Enbridge ENB. Now, there's a reason why I picked this one, and it's not for the fact that they pay a 6.5% dividend. The reason why I picked Enbridge is because Enbridge is starting to set itself up really well into the future. Obviously, they do gas and oil pipelines right now, but they also have a growing portfolio of energy or green energy stocks, stuff like wind power as well as solar, and they are also starting to get into battery power when it comes to the electrical grid, so that they can store some of that wind power when it's not windy and solar power when it's nighttime. However, they have an average volume of 9 million shares traded every single day with a 6.5% dividend. You can't deny how strong that is. They have been really strong recently. Of course, there was a small hiccup right there. However, why is this company doing so strong right now, and why did they drop there? Well, oil prices went negative there, and since then, oil prices have been going up. No matter how much green energy they are trying to do, right now they're still classified as an oil pipeline company, and because of that, they will be basically moving in line with, of course, oil prices. They also just recently upped their dividend, and they were also increasing their dividend during, of course, the virus that has been hitting the world. Their earnings have been actually not that bad either. They've got 3 beats and 1 miss. The miss was recent, however, and they still had strong revenue and earnings in 2020. However, 2021 was a lot stronger, and we can see that it's going to be even stronger into the future because their revenue was less than 2019, but they had higher earnings, which, in my opinion, cash flow, right? The amount of cash that you're bringing in is important, but also how much of that cash you get to keep, and that is important there. Next is Canadian Natural Resources, CNQ. Now, this one also has a huge volume that gets traded with it. However, it does have a 3.5% dividend, and it's an oil stock. And when it comes to oil stocks right now, they're doing extremely well because of who is currently in government. We have Trudeau, who, of course, apparently likes to buy pipelines and never do anything with them. And then we also have Biden down in the States that, of course, he basically likes to shut down oil mining and buy it from the Saudis, which then ups the price of oil and allows companies like CNQ to make more money. Its 5-year chart's been pretty solid as well. Of course, there was a small average dip across 2018-19 and of course going into 2020. However, when oil prices went negative, it dropped substantially. That would have been an absolutely fantastic time to buy it because look where it is today. And the reason why a lot of oil stocks were not doing so well before 2020 is because, of course, we had Trump in office. Now, I'm not saying Trump was good or bad. Everyone has their own opinion. However, what I am saying is the fact that with Trump, he was opening up a lot of fracking, in which case Biden then shut it down. And because Trump opened up so much fracking, the United States was energy independent. They didn't have to go outside of the country to buy oil, which then plummeted the oil price. And then, of course, we then got Biden in office. The virus pandemic then started, dumped oil negative because there was just so much oil flooding the market. And then since then, Biden's shut down a lot of the fracking, and of course everyone's cut back on oil mining, in which case the price of oil has skyrocketed through the proverbial roof. And because of that, we then have companies I should say countries like Canada and the United States who are buying their oil from the Saudis, in which case is worse for the environment for number one, but also they are now able to then limit how much they mine so that they can up the price so they can make more money. And because oil prices are going up, So is their dividend. Their dividend is increasing substantially. It's gone from 47 cents a share to 58.8 cents a share, and they have been beating earnings estimates for the last 4 quarters. However, 2020 wasn't exactly a fantastic year for them. They did have negative earnings. However, we can see in years past that their revenue was going up with their earnings as well, and we can foresee that hopefully happening into the future. Next is Power Corporation of Canada, POW. This is another energy play. However, this one pays a 4.9% dividend with a 1.5 million average volume, which is super easy to get in and out of. Recently, it's been trading sideways. However, it's had a good run, and it was pretty well trading sideways beforehand too. With companies like this, it's always good to get in whenever it starts dipping, because of course, if you can just buy and not have to worry about it and hold it for 5-10 years, if you're younger like myself, you will find that of course you'll be able to have massive growth. And you can't deny the fact that they continue to raise their dividend as well. They pay a quarterly dividend. And I really like the fact that they've beat all 4 quarters and have continuing revenue growth. Look at that growth in 2020 versus prior years. Fortis is another solid stock. This one has fantastic growth over time. Since 95, it's just absolutely exploded, and not really that many crazy downturns either. It's got a 3.6% dividend, 1.4 million shares on average per day, which is fantastic. PE ratio is not bad versus others in its field too, which is just absolutely fantastic. Recently, over the past 5 years, we can see that it did have a little bit of a drop while everything else was dropping, but it recovered faster than pretty much anything else that I've seen on the stock market, which is fantastic. It just hasn't had a massive run since then. Imagine if you could have day traded this back then and then got into other stocks to have a higher growth afterwards. Fantastic option to trade, but hindsight is always 20/20. What I really do like, especially for long-term investors like myself, is of course the dividend growth. We can see that back in 2017 they were paying 42 cents a share, and now they're paying 53 cents a share, which is a 25% increase in about 5 years. They've, however, had 2 misses recently, 1 meet and 1 beat, so this right here over the last 3 quarters is kind of concerning. However, they still have revenue growth, which is important in my eyes. TransAlta is, in my opinion, one of the top stocks right now to get because, of course, just this whole energy play that's happening right now. And especially when it comes to green technology, this is very important. 5.6% dividend, you cannot deny. If you are looking to get into green technology, then this is the play to have if you are a dividend investor like myself. 430,000 shares traded per day is very easy to get in and out of, especially at $16 a share. RNW is its ticker, and when we look at the chart, we can see that over the past 5 years, it's had its kind of ups and downs. It's currently on a down right now, and it could be an interesting time to actually get into this. The only thing is they don't tend to raise their dividend very often, so if you're looking for dividend growth, it's not there, but they do pay it every single month, which of course is something that is nice to have. However, they have missed pretty much every earnings they've had over the past year. They've had earnings decline, revenue slightly decline as well. However, if you're looking 10 years out, this could be a solid company considering how much the government is actually looking to invest in this stuff. And we can see that the Canadian government is really starting to invest in this type of technology, these types of companies, because of course when we start looking at who they have in office, which is Trudeau, we can see that who he's putting into basically in power for the whole green movement is somebody who is in love with Greenpeace, which in many countries is classified as a terrorist organization. I would say that they're probably going to be investing even more money into companies like this. Nutrien is another interesting company to invest in, 2.5% dividend and 1.3 million shares traded every single day. This is also very interesting. Very low PE versus others in its field too. And we've seen huge growth because, of course, this is a fertilizer company, which means that, of course, what do we need right now? We need food. Where are we going to get it? Well, guess what? Our dollar is going down the drain. We're going to have to grow it ourselves in this country. We're going to have to start moving more products in our country. And because of that, of course, we're going to need farmland. We have farmland. And, of course, that is a company that provides to, of course, 1,500 retail stores and has a massive, massive farming impact. Also, can't deny the fact that with food prices going through the proverbial roof, we're going to see a lot more people who have homes or even apartment buildings looking to grow their own fruits and vegetables because they're getting so darn expensive in the store, and it's generally sometimes cheaper to grow your own tomatoes and stuff than to actually buy it. So what you're going to need is fertilizer. They're in 1,500 retail stores. Guess what? You're going to need fertilizer to grow food. Also, something else to really mention is the fact that there is more and more people starting to go over to organic, which is what you would generally have, even though fertilizer has nothing to do with organics at all, but people will think that because they grow it in their backyard that it doesn't matter, it's organic anyways, even if you're using fertilizer. So either way, when you're looking at the whole healthy movement, people who have been reading or at least worried about the virus that's currently going around will understand that eating healthier will help you not get sick as bad. So because of that, I think that there could be an even bigger movement towards farming and as well as doing your own stuff in your backyard. They also increase the dividend quite frequently and also decrease it quite frequently as well. They do pay a quarterly dividend, and what you can do is look year over year, and we can see that there is an increase there. However, when we look at June, there was a decrease recently. So keep that in mind. Still a very interesting company to invest in and, of course, look at. And we can see that, of course, in 2021, it was a fantastic year when it comes to revenue and earnings. Can't go too far outside of the TSX into the TSX without seeing a Canadian bank, and you're going to see a lot of them today. And basically, TD is, of course, a bank that currently trades at a 13 PE ratio. Generally speaking, my strategy with the Canadian banks is to look at the big six banks and look at two different things. This is how I personally invest in the Canadian banks. Number one, who has the highest dividend, and number two, who has the lowest PE ratio. Try to mix those two together, and there is the perfect investment when it comes to the Canadian banks. There's 6 of them. You could literally just throw like a couple $1,000 in each and let it sit there for like 40 years and you'll be fine either way. They generally will have 2 or 3 that are favored every couple of years and then 2 or 3 that are not favored every couple of years. And then at that point, you just basically invest in the ones that have a low PE ratio that are currently not being favored. Right now, for example, would be Bank of Nova Scotia. And at that point, or Scotiabank, and because of that, in the future, they will then be the ones that are favored. TD, BMO, they won't be as favored, and they kind of go through their own little cycles. And every single Canadian bank is going through the roof right now. Like, this is crazy, and there's actually a really good explanation behind this. They've all recently upped their dividend after not being allowed to because of the virus. Higher earnings, higher revenue, beating quarters. This is exactly what you're going to see across all the banks. You're going to see this with Royal Bank as well. This one has a 12.75% or 12.75 PE ratio. This one's also having huge growth as well. Dividend growth, especially recently. Revenue, earnings growth. Again, you're going to see this across all the banks. Bank of Montreal just made a huge transaction buying an American bank, a massive American bank. It was the largest bank purchase of the United States ever for a Canadian bank. Again, huge growth, nothing beforehand, but huge growth since. I think it was BMO that had the largest dividend increase as well. Massive growth again, 4 quarters beat. This is huge stuff. National Bank, again, another one. This one was actually doing quite well before the virus. Very good amount of average volume as well as a 3.4% dividend. This is why you invest in all the banks, because this was actually doing quite well before the virus and has been doing not too badly since. They raised their dividend too. However, National Bank has had huge or bigger revenue and earnings growth after the virus started. This is Bank of Nova Scotia, in my opinion, one of the ones to buy right now. It's a PE ratio of 11.9, 4 million shares traded every single day with a 4.3% dividend. And we can see that before the virus, it was actually going down, and since then it's been somewhat doing okay. Now, why is this a trend in Canada banks? Why is that such a trend? Why are we seeing this huge growth in revenue and earnings when it comes to the Canadian banks? And of course, dividend growth through the roof. We're seeing this in CIBC too, 4% dividend, 11.5 PE ratio. This is another one to be really looking at. This one would be actually a better option because it's had better growth recently with a lower PE ratio and a very very good dividend too. Had pretty good dividend growth as well, and huge revenue growth. However, they did miss recently on their earnings. Now, why are we seeing this trend when it comes to the Canadian banks? Well, there are a few reasons. Number one, they had to put money aside for loan loss provisions. They're taking that money out and it's showing as revenue growth and earnings growth. That is one of the reasons. However, the largest reason is because the Canadian government is currently printing $500 and something million per day. Where is that money going? It doesn't just sit there in the government's pocket. They need to spend it somewhere. Well, where are they spending it? Well, they're spending it on giving it to people, the citizens, and CERB and whatever else they have now versus the CERB. They've changed the name, but either way, they're giving it to the citizens, the civilians, as well as also giving it to companies that are basically trying to stay afloat during this time. Well, where does all this money congregate? It doesn't just sit in the pockets of people. Where does it go? And that money goes to the banks. There is a reason why these banks are having massive money growth. It's because when they get money, let's say they get $1 in, they can loan that same dollar out 10 times over, which means that they can make even more money when the government is printing money. That is just how it works. And that's why it's not just a Canadian issue when it comes to inflation. It's a worldwide issue because it's not just the Canadian government printing money, but it's the Americans, Europeans. Everyone is printing money like there is no tomorrow, and that is why the inflation is going through the roof. And when this happens, well, guess what? The money has to go somewhere, and that's JP Morgan, TD, Royal Bank, Citibank, all of these banks, Bank of America, all of the banks are going to be getting richer because of this money printing. The more money there is, the more money that they can make, which then means that money is worth less, and they're just going to make more of it anyways. So when that happens, guess what? They're going to be making a killing during this time. Yes, we're going to see inflation. Yes, we're going to see interest rates going through the roof. Guess what? Banks make more money when interest rates are going through the roof. Banks right now are set up so well that they, I don't think, have a chance of even failing. So because of, unless there's a lot of loan loss, which they, in Canada, they have insurance against that anyways with the Canadian government. So either way, if the banks start saying, hey, we're having a lot of loan losses, well, it's insured by another company, which is then insured also on top of that by the government. If anything, the government would fail, which for anyone who hates Trudeau would probably be a good thing. But anyways, that is my take on the top 11 companies on the TSX, why I think that these are fantastic investments right now and into the future, at least for the next couple of years. Let me know your comments down in the comment section below. I'd love to know your thoughts, and I'll see you guys again next time.